Merger rumours as AMMB Holdings and RHB Bank request a suspension of trading of shares starting 9 a.m. tomorrow pending a material announcement. This means all structured warrants relating to the two lenders will also be suspended. In March, The Edge Weekly, quoting sources, reported that talks of a potential merger between the two mid-sized lenders had resurfaced in the banking industry. Citing a source, the Weekly said that a big accounting firm has been working on a certain aspect of the prospective union. A merger between AMMB and RHB would create the country's fourth largest banking group by assets, behind Maybank, CIMB and Public Bank. The development comes as AMMB reported its fourth quarter numbers today, with earnings jumping 20%, mainly on the back of other operating income. Net profit rose to 335.81 million ringgit, up from 280 million the previous year. Revenue inched up by 2% to 2.15 billion. It proposed a final dividend of 12.6 cents per share. Malaysia and China are reportedly set to hold meetings in the coming days to push for the proposals for several mega projects. The discussion is said to be on funding options and implementation timelines for the development of the Malacca Gateway Port and the Carey Island Port. Also included the proposed development of a dedicated energy port in Perak. Separately, Finance Ministry Secretary-General Irwan Seriga is also slated to lead a delegation to Beijing later in the week to meet potential players for the Bandar Malaysia project. He is said to be expected to hold talks to gauge interest of Chinese state-owned enterprises such as China Overseas Land and Investment and Greenland Group, as well as private developers like Dalian Wanda. MITI Minister Mustafa Mohamad believes Malaysia is still on track to achieve its high-income economy ambitions. This despite the country's labour productivity growing 3.5% last year, 0.2% shy of its target. Labour productivity grew to 78,218 ringgit in 2016 in terms of added value per employee, due to uncertainty in business confidence and the financial markets. However, Mustafa says the growth rate is still positive. He says this means that Malaysia has achieved 84.7% of the 11th Malaysia Plan's target of 92,300 ringgit by 2020. Sime Darby saw a modest improvement in third quarter earnings with higher income from its oil palm plantation, heavy equipment and car dealership divisions. Net profit improved by 5% to nearly 700 million ringgit from 663 million ringgit previously. Earnings growth was however capped by higher tax and perpetual sukuk expenses. Meanwhile, revenue stood at 12.45 billion ringgit, that's a 21.7% jump from a year ago. Sime Darby expects its performance for FY17 to be satisfactory, and according to President and Group CEO Muhammad Baki Saleh, its listing plan for its plantation and property division is on track. Felda Global Ventures managed to return to the black for its first quarter. This is due to higher revenue and lower admin expenses. Net profit stood at 2.47 million ringgit as opposed to a net loss of 81 million a year ago. Revenue jumped by over 15% to 4.32 billion ringgit from 3.76 billion ringgit previously. The company performed better, mainly due to its plantation and logistics sectors, which benefited from better palm oil product prices and production. Admin expenses shrank 15% to 220 million ringgit, but profit was offset by its loss-making sugar business, an impairment of receivables worth nearly 30 million ringgit, as well as lower profit share from its JVs amid lower forex gains this year. Group President and CEO Zakaria Arshad says Malaysia's overall production this year may be lower than 2015, as labour shortages could further moderate the CPO outlook. However, he adds that the company remains proactive in securing a sustainable supply of labour for its operations, alongside increased mechanisation of estate processes.